Well, Indusind Bank has performed fairly in line with what ET Now poll was expecting. The profits at 877 crore is largely in line with our expectation of 840 crore. Net interest income has grown at a pace of 9%, and the operating profits also at a similar pace of 9.5%. If you look at the Q4 gross NPA ratio, that has come down to 2.67% versus the proforma GNPA of 2.93% in the last quarter. Of course, the absolute gross NPAs have jumped to 5,800 odd crore versus 3,600 odd crore in the last quarter. So yes, in terms of the asset quality, just looking at these numbers, Indusind Bank has performed largely on similar lines with the other large peer banks. Advances book has gone up only by 3% on a YY basis, as the bank had made a conscious decision to slow down the corporate loan book, and they continue to maintain their domain market share in both vehicle finance as well as the MFI book. They also mentioned in the press release that the total provisions at 2,200 crore towards COVID-19. This includes floating provisions, counter-cyclical provisions as well as contingent provisions, and also management states that the extent to which the COVID-19 pandemic and the second wave will impact the bank, that is still uncertain, and hence they refrain to share any guidance for FY22. At the presser, management also mentioned that their overall collection efficiency stands at 98%, their restructuring book stands at 1.8% of their overall book, and the total recast assets stands at 3,700 odd crores. The MFI book has seen a good growth of 14% quarter on quarter, and they have seen the vehicle finance book grow at nearly around 7% YOY. They have taken a conscious decision to slow down the unsecured loan book. Management also mentioned that they continue to maintain market share in the CV segments, and overall the disbursements in the vehicle finance book has grown at a good pace. In fact, the CV book has grown nicely during Q4. Disbursements are up nearly around 40% QOQ, and the CV book has crossed the pre-COVID levels. Tractors also is doing well, and they believe that CV is likely to be the best year as it is coming on a low base. He said that there is demand for personal mobility, and in terms of the MFI book, accessibility is a key factor here. If the economy rebounds, then they would probably see good growth here. So overall, they do remain confident of maintaining the market share in the domain of vehicle finance as well as the MFI book. However, they did state that it is too early to give any guidance for FY22.